Hi, welcome to chapter 21. This is all about whether policy making, specifically fiscal policy, should that be restrained? Meaning, should the government or, and we'll see in the next chapter, even the Federal Reserve, the central bank, should they be doing less and not be super active and doing more? So, should policy makers be restrained? Fiscal policy and monetary policy. And the reason why this topic is important is there are a lot of reasons we've learned over the last few chapters where we've learned about issues with policy. So this chapter actually um, goes in detail about can we make rules around policymakers, because in a sense the game of macroeconomics is the game between policymakers who are chosen by the voters, and they impact the economy, and they have a huge impact on the lives and the livelihood of the people. So if we can think about the game of policy as people who are in Washington D.C., who are selected by the voters, who are making policy decisions. Fiscal policy specifically is the focus of this chapter because it has an impact on the country. Yeah, unemployment could have huge issues because of how um, economic activity is down, or it could be that the price level is high, and so and there is a huge um, spiral in terms of inflation, like hyperinflation. So there could be various reasons and crisis that the country might be facing, and so it might require for policymakers to take action. And so if we can think about these policymakers making policies that impact the country, has an impact on overall the people, and these people, these policymakers are in a sense also playing games with the other policymakers. They also want to be selected, they want to be re-selected and voted in to represent the people, but at the same time they're also trying to get consensus and get other policymakers to have policy decisions such that the country can benefit. So if we think about this multi-pronged stakeholders that are involved here, the voters, the people, the economy, the country overall that has the industries that employ the people, but also these other policymakers who want to get elected. There's politics around this. If we keep this lens in mind, then we'll quickly realize that this is not a simple game of restraint that we can have on these policymakers. But you could say, hey, you cannot grow money supply beyond certain percent. You cannot increase the debt beyond certain percent, or beyond a certain fixed amount, or even the debt to GDP ratio um, would have a high watermark, and the deficit as a percentage of GDP could be less than 4%. You could have so many such rules that you could enforce on the policy makers, and through legislative changes in the constitution and things like that. And it has upside and downside. And there are some things we can learn from the Eurozone on how the Euro area did the fiscal rules, and we'll get to it. But in a sense, rules can help, is the key idea, but they cannot really substitute for the lack of resolve of policymakers. If these policymakers really care for the country, that's definitely one aspect. But then they're also playing games with other policymakers, and they're playing the game so that they get re-elected by the voters. And there is a lot to learn from what the European Union have done, and we can go over that scenario as well. Yeah. So even a simple thing like, let's say the economy is currently facing high unemployment. Yeah. And there's a policy decision that the policymakers are trying to have, which says We want to reduce interest rate. Yeah. And by that, they feel, they know that they can increase the economic activity. And when they did that, the country would um, have better employment. But even this link, right? Reducing interest rates to increasing economic activity and thereby having better employment and reduction in unemployment, there are lots of questions that need to be asked. Policy making, in this case, this decision, by in this case, we're focusing on the monetary policy because of we're focusing on the interest rate. Um, but lots of questions need to be asked, and you need to be sure that this is the right decision. The first question is, what is the rate of unemployment? How high is high? Is it above the natural rate of unemployment? And what if you reduce the interest rate and the unemployment, which you thought was high but is actually permanently now high? The unemployment, the natural rate of unemployment is now permanently high. Then what happens? You would risk causing inflation. So you would want to know where the current levels are and what are the natural rates of unemployment. Have they shifted before you make this decision? That's just one of the questions. The other question you would have is, okay, I'm going to reduce my interest rate. What's going to be the impact on the long-term interest rate for the bonds of the country? Yeah. And we've seen that in chapter 14. And how much would the stock price go up? And how long will it take for it to go up? Yeah. And what will be the impact on the currency and thus overall trade? If the currency appreciates or depreciates, what's the impact on import and exports? How competitive is the country's imports going to be? Because if the currency appreciates, it's cheaper to get more goods imported. But if the currency depreciates, then the export market becomes much more competitive. The country can export much more. So those are the trade-off. Like if I reduce the interest rate, what's going to be the impact on my currency? Yeah, impact on stock market and stock prices. And how long will it take for these decision, even if I made the decision, to impact the activity and thus investments and consumption and spending and overall economic activity would go up, but how long will it take? And in what is that, we talked about currency appreciation, depreciation, but that has an impact on trade balance, yeah, import, exports. So these are just some questions. Like even one decision here to directly impact economic activity, there are lots of things, and we just listed some of them here. Because even if they make the decision, first they have to detect that there's a problem. Then they have to get consensus among policy members that yes, there is a problem, and then they have to implement something, and that takes time for implementation. So detection, consensus, implementation, and by the time they implement, maybe the economy um, has it too late, or maybe it's already recovered, and maybe it's quite too late. So in a sense, that along with if you add forecast errors, which we will see in the next slide, there is lots of uncertainty, even if you want to change one thing. And so that's one of the reasons why there are arguments against active policy makers, meaning get them to slow down. They don't know much, so they should not do much, right? Um, there's a saying in this chapter in this book that says, "Those who know little should do little," something like that, and that was quite interesting. But in a sense, this simple decision is not simple. It's quite complex, and you have to think through what are all the changes and how it impacts. And we've seen in the last few chapters how these are all connected, so we can better understand what the impact is once we see the policy decision. So speaking about the forecast errors, right? Look at this one. There are so many. There are like the 10 macro models that are listed here, um, and then and it predicts the output response to the output, which is the change in GDP, to monetary expansion. Yeah. So percentage deviation from the baseline. So if you have a monetary expansion, could be through a reduction in interest rate, what do you think is going to be the response on output or GDP? Well, each of these models, if you start to see that they have a very different set of range of outcomes. Yeah, some models, the Eagle ECB goes up quickly, or the Quest goes up quickly, but there are certain that goes up slowly. And so there's a range of answers here, and that tells you that there is lots of uncertainty here. And each of these models, with based on the assumptions that it has built in, will give you a different answer in terms of what will be the impact on output of this monetary expansion. Yeah. So in a sense, even if you build all of these complex models, and there's an army of economists for each of these models and each of these macro models, and so even there's so much of range of variation. And it is because it's trying to model in the uncertainty involved with all of those. We listed 6 questions. There's probably 15 other questions that we didn't list in the previous slide, which shows all of the things that you have to think through and check and validate those assumptions. Yeah. So in a sense, while a lot of this is true, a policy, if it is passive, that's more problematic, primarily because you could have crisis situations like the COVID-19 or the global financial crisis. And if you have those large, prolonged recessions, then you would potentially get into the depression type type of situation, which is pretty bad to come out of. So policies that actually slow down the expansion, there are the boom time expansion, and policies that reduce the prolonged recessions are the best set of things for the policymakers to think about, which is, do not get too active when things are okay, but if it's too much frothy, you'd want to slow down the boom, and you would want to also recover from the bust much faster so that there's not many recessions and the length of recession is smaller. Yeah. um, and once you've achieved your goal, you would want to stop. Don't keep making more and more policy changes. That's the key thing about not fine tuning your policies once you achieve the high level goals. I think, based on looking at this, and there are two economist camps, right? One says more active, one says more passive, and active is what a lot of people lean towards, because look at some of the data here as well. This shows the recession over the last 50 years. The number of recessions and also the duration of recessions have reduced, and that tells you a lot, right, about active policy making, fiscal and monetary. And these decisions, whether it's fiscal in investments in spending in infrastructure or R&D, these have long-term benefits. And even though there is forecasting limitation, lag associated with detection, our systems are getting better. Yeah, there is political biases involved with all of these, the games that we talked about, the policymakers playing with each other, with voters, trying to get elected so that they could have higher chances to be in office. So there's a lot of set of games happening, but net net, they're getting better. And if we look at the last 30 years, the United States has taken, starting with slightly passive to mostly active stance through all of these fiscal changes. Yeah. Last surplus we saw in the United States was around 2001, but since then, tax cuts after tax cuts and the various crisis scenarios that we were able to come out really quickly through the fiscal intervention and also the monetary intervention. The troubled asset relief program that bailed out the banks in the global financial crisis, the American Recovery Reinvestment Act, again, each of these around $1 trillion. And we had tax cuts from the first Trump government, and we had the COVID-19 response for almost $2 trillion for the Coronavirus Aid, Relief, and Security Act, and the latest one being the Infrastructure Investment and Jobs Act, $1 trillion, and Inflation Reduction Act, and another $1 trillion. So there's a lot of money going into these fiscal expansion per se through tax cuts and through stimulus in the economy. And that has served us well in the sense that the number of recessions and the frequency and the duration and the intensity of recessions has greatly reduced. And all of these stances, right, all of these actions are leaning towards active more than passive, which was, more than 30 years ago. Um, and, you know, more active. Is there something we can learn from the euro area? That's the next topic, yeah, which is, should you have rules on these policymakers now that they're more active? Do you want to put in rules so that they don't get too crazy? And so that's where we can learn from the euro area, which built a lot of rules, the fiscal rules in the European Union. And as part of the Maastricht Treaty negotiated in 1991, they actually came up with convergence criteria, which is a set of qualifications that the euro countries, the countries who want to join the euro area should meet. First one being, and these are all restraints, right? Fiscal policy restraint of budget deficit to GDP less than 3% year to year. Yeah, every year can't go above 3%. Debt to GDP overall 60% or less, or approaching that. So they actually negotiated this treaty in um, during 1991, but then they had to wait because not a lot of countries would meet that. But due to strong growth, what happened is they were close to balance, and they were this treaty that was negotiated was put in place. But they also wanted to make some of these recommendations permanent. So they came up with a new enhancement called the SGP, Stability and Growth Pact, which makes some of these fiscal constraints that we talked about, debt to GDP less than 60%, deficit to GDP on a yearly basis less than 3%. So, and that the countries would have legislative changes to make the fiscal restraints permanent. Yeah, meaning they would make um, balancing the budget in the medium run a legislative requirement. Yeah, and then they would put in sanctions of 0.2% of GDP to 0.5% of GDP after signing the SGP, the Stability and Growth Pact. Yeah, so this they were able to get to this low budget to deficit budget ratio of budget deficit to GDP primarily because of strong growth. Yeah, um, nothing about fiscal policy is where this factors were leading towards. But and we will see why that's the case, because what happened is during 2003, 2001 and 3 onwards, Portugal, France, and Germany, they all were in violation of this 3% deficit to GDP ratio. And so while they could start this sanction on Portugal, it would be harder to do it on the largest countries in the European Union. And so it was quickly realized that this these rules were not credible, meaning you couldn't do it. And so they were in violation. But again, post that period, there was strong growth, and then they all came very close to less than 1%, so very close to balance. Then the global financial crisis hit, and uh, the ratio of 3%, 23 out of 27 countries were in violation. They were actually 6% deficit GDP ratio. So most were like out of violation. Most were in violations. And so what that meant is that these rules, even though they were, started with the Maastricht Treaty, and then they enhanced it to Stability and Growth Pact, and they enhanced it again to Stability and Growth Pact 2, I think somewhere here. So they kept enhancing, kept changing the rules. Yeah, because situations changed and they had to be flexible. And then they signed in 2011, based on all of these learnings, Fiscal Compact. This is a huge set of recommendations that they that they that they all negotiated and agreed on. It provides lots of flexibility, um, but there's lots of changes that are required in the legislation to balance the budget and so on. It's a huge set of things that they have to do that they signed on 2012. All worked well. All but Spain were in compliance before the COVID crisis. So this was all good, but at COVID crisis, they realized that this will not work. Uh, the deficit to GDP was much higher, again, much higher than the 6% peak that they saw in the GFC. And then they realized some of these rules are too complex, confusing, and most of these rules are now suspended through the COVID crisis, and negotiations and conversations are going on. What do you take away from this? The biggest takeaway is building simple rules is hard because those simple rules will not work in many situations. And so, while you want to provide the governments the flexibility to have a fiscal response that's appropriate, you also want to protect the downside that they don't go and put up more and more debt. So, both are important, and doing it with rules does not work. And that's what the euro area has taught us in some sense. Yeah? What we've also seen, though, that works is if you have a central bank that is independent, higher independence, you will see the inflation rate be lower. Yeah? So if you want to achieve low inflation, having a credible central bank, a central banker who really cares about inflation much, much more than, let's say, even unemployment. You have a mandate for inflation and unemployment. If you're a conservative central banker, you appear as if you dislike inflation so much. Um, and if you did that, and if you had a central bank that is independent of the government and independent of the whims and fancies of the short-term view that the political party would have for 4 years, you hire them for a longer period, and then they work for the long run, then you start to see that you have better fiscal response. In this case, inflation was much lower for some of these countries. So this is pretty important thing that does work. Yeah, rules may not work, but independent central bank with who's hired, the people are hired for longer run, who can plan for the long run, who can be accountable for the long run, and who will stay and do the things that are needed in a credible way. That is what works. And what we've seen is some of these numbers around how debt to GDP ratio have been increasing. This is from the IMF 2023 report, the Fiscal Monitor, and you see that there is increase globally in debt to GDP ratio, and this is all the way until 2024, and there's also some projections here. China was low and until 2015, it has started exploding after. Currently, the deficit to um, GDP is around 7%. It's still very high. It was close to, um, so in the GFC, it was close to around 10% and 14% in during the COVID time. And surplus was only during one time. Yeah. And so you start to see some of these trends. You will see some patterns around when things are, some of these are estimates and forecasts. So you would have some sort of a range associated with it. And United States continues to be above 100% debt to GDP ratio. Yeah. And what we also see is that there's strong movements in bond prices and bond yield in for, let's say, compared to advanced economies in blue, the foreign country dominated, currency dominated, local, so it's a US dollar dominated, let's say, 10-year bond, and then And then we have foreign currency denominated bond, which is here. Um, so local currency would be like, let's say, in that specific country's market. Let's say it's Mexico, then Mexican peso, and then here it's the same in terms of uh, so yeah. So here we see there's movement that is roughly they follow the patterns that are like they move together, right? Primarily because most countries, close to 60-70% of countries, they don't have a fixed exchange rate. They have a floating exchange rate, and that allows them to change, um, the exchange rate, and that has an impact on the bond yields. Yeah. So the world has come together, and that's one of the reasons why you also see here that globally there's a trend up as well in terms of deficit and debt to GDP ratios. Um, let's specifically look at one aspect here, which is why the US have a pretty sharp leg up here in terms of debt to GDP ratio, and it's continued to stay above 100. And this is what this chart will help us. What we've seen is that the debt to GDP ratio in the United States have uh, always had a spike during some crisis scenarios. So World War One, big spike, stays there, improves. Another spike, 1930s depression, then slowly improves. And then World War Two, big spike. Look at that. During World War Two, it was about 120%. That's what it is right now. So it's pretty crazy how what the levels are that we're currently operating under. But we saw a huge improvement since 1940s until 1980s, at which point the Reagan administration um, added tax cuts, which was followed by Bush administration again tax cut. And then there's a huge crisis again, global financial crisis. We had a huge jump up in debt to GDP. Yeah. So most of these build-ups and the COVID-19 crisis another build-up. Yeah. If you have some of these tax cuts, um, these are these are fiscal policy responses. Um, is that really needed during that time? We really needed to cut the taxes in these situations. The idea was that if you cut the tax, that people would become more productive, leading to higher output and higher tax revenues. But that has actually not worked out as much because you start to see that it didn't help the debt to GDP ratio because it continues to go up, and then there is this bias around. Um, it's super easy for politicians to raise uh, raise the debt level, right, through deficits during crisis scenario, but during boom time, they will not do a contraction. So that's the problem. Yeah. Um, there's a tendency towards always uh, not contracting when things are going well in the recent past. And that's something that needs to be looked at in much more detail. Yeah. So that's one of the reasons deficits every year were high up. And that adds to the debt stock overall. Yeah. So that's the evolution of US debt to GDP. Let's look at this even more in detail, right? Like what happened in this time frame where who accumulate this is right this entire chart is a public debt, yeah, evolution of US public debt to GDP. So US public debt went up almost from 55% to 105, or double, yeah, almost doubled in this time frame. So let's look at that situation in slightly more detail as to what's going on, yeah, and why did we have that crisis in the first place. There are several reasons, but there was lots of deregulation in the financial um, markets, right? And most banks followed the Basel II framework, which allowed them to um, have capital much lower than the requirement. Uh, if you were to assess the risk associated with the assets that they were holding. There were really many more complex instruments that were added, like mortgage-based securities, and and modeling for what is the risk associated with those complex instruments were hard. And so these incentives around capital requirements associated with risk got people to, incentives were not aligned because they were incentivized to show lower risk and thus get lower capital requirement, and so they showed lower risk. And so due to various deregulatory environments, which really brought the Glass-Steagall Act was one that I'm listing here, that really brought, in this case, the financial institutions like banks who are taking in deposits, and also investment bodies who are actually making investment decisions really close together. And this got excessive risk taking appetite was built in. Subprime mortgages were given out for those folks who couldn't really afford it due to high risk taking. Loans were given out. And so what happened is, if you look at the commercial bank's balance sheet, yeah, who was giving out these loans, you would have that they give out these loans and they have deposits that they come in their assets. And then they also held this mortgage-based securities, these complex instruments, um, and they have their net worth, yeah, which is the capital retained earnings that they have, and also the equity that the owners of the bank have, yeah. So what we see is that if you look at the liabilities and assets of this balance sheet of the commercial bank, and look at similarly the um, assets and liabilities of the central bank, the Federal Reserve, you will start to see that there's interaction happening between the commercial bank, the central bank, and the government. Yeah. So during this 2008 crisis, what happened was the loans, um, the housing market, there's a trigger around how the house value started to go down. That triggered into folks not being able to pay back their loans and mortgages. And so when that happened, commercial banks started seeing a lot of losses. Yeah, they started seeing losses to which the biggest impact was on their net worth. Yeah, they they had to the capital owners, the equity owners, the commercial banks suffered because they're starting to see losses because of loans not being paid, and some of these mortgage-based securities hard to assess into the complexity, and so they couldn't get out of those toxic loans quickly, and their net worth decreased, and so equity owners were like, "What's going on?" Right? And then even the depositors were like, "I probably need to get out of this bank," right? And even borrowing became harder because if you start to show losses because your assets and liabilities and equities should balance, right? The balance sheet. So when this started to deteriorate, the net worth reduced. The stock owners, the first one of stock owners of the commercial bank were the first ones to be impacted. And the next step, if nothing was done, would be the depositors or even the bondholders, right? So they'll all get impacted if the bank were to default, right? So what happened is the government um, realized that there is the possibility of a bank failure, and primarily because the bank would go under, and then if there's a bank run, that would be a huge issue. So what happened was government stepped in, and what they did is they, through the troubled asset relief program and through quantitative easing through the central bank, what they did is government issued bonds. Those bonds were bought by the central bank, and the money that came out of that selling that bond was given to commercial banks. Yeah, and that money was given to the commercial bank, and the government got preferred shares into the commercial bank. And so what happened was the bank liquidity situation was taken care of, the net worth, the capital requirement went up, and so the bank became healthy because of the infusion from the government, yeah, and capital injection. And primarily, when the net worth was taken care of, there was no issues with liquidity within the bank. The banks got some time to get rid of these and restructure some of these bad loans and get rid of these toxic assets and rebalance. And they got time to actually improve. And in a sense, what happened was these bad loans were the private bad loans were actually replaced by this government public higher debt, right? In a sense, the government now owns a claim on during the after the transaction was done to in preferred shares in these banks, and then they made more than enough money actually after 2008 bailout. That the taxpayer actually made a lot more money through this holding of these shares, and then government eventually sold it. But in a sense, they were able to give these banks who were in trouble uh, capital infusion, and those securities were also bought by central bank through quantitative easing. So those assets were bought by the government, and so in a sense, they have a higher debt level. Private debt was replaced by public debt. We call it private debt, but think about this: if the bank was um, going to fail, then all these depositors are public people. They would have not gotten their money back. So letting the bank fail is just not an option. And so we say it's private bad loans, which was true because there was this mortgage-based securities that were toxic, too difficult to even quantify the risk, and in a short period of time when you have a run, um, and some of these subprime mortgages were indeed bad. So there's some amount of bailout, but in a sense, it came down to people, actual people, getting the benefit from it. Yeah. So the central bank had an expansion. So did the government debt, balance sheet, both increased. So that's how we see debt level overall increase through just one scenario of 2008 global financial crisis. So if you remember one thing from this entire um, video, it's about remember the fact that active policy making is helpful during crisis. Policymakers should be not restrained through rules around like fixed capital, fixed money growth, or certain random simple rules which will only work in certain scenarios. It's actually important to realize that this is a game between policymakers and the economy, policymakers and the voters, policymakers themselves. And so putting restraint in policymakers is helpful, but it's hard. And so what we've seen is that policy decisions over the last 20, 30 years, as we saw in the chart, has actually gotten us to be much more stable, uh, less recessions, and getting better and better at it. As long as we don't fine tune policy decisions, once we hit the goals, then it should be fine. Yeah. Thank you.